Hello and welcome to an FX Times daily video recap. I'm CMS Forex market analyst Nick Nassad. Today's Monday, November 23rd, 2009. We start today's recap by looking at some comments from a Fed official on Sunday. This was comments by the Fed St. Louis President James Bullard, and he pretty much said that he wants to see the Fed continue to buy mortgage-backed securities beyond the currently planned end of that program on the first quarter of 2010. The Fed has already committed to buying $1.25 trillion of agency mortgage-backed securities and around $175 billion of agency debt as part of a bid to keep borrowing costs low and supportive of economic growth. James Bullard is not a voting member of the FOMC, though he will be next year, and he's known to be more of a hawkish Fed official, so his comments may shift some market expectations regarding what the Fed will do once the mortgage asset purchase plan is set to run out. So if there's going to be an expansion to perhaps a smaller version, that will be ongoing in maybe the second quarter. So his comments deviated from what we saw from ECB President Trichet on Friday, where he made it clear that European banks should be getting ready to see a withdrawal of some of the extra liquidity that ECB has been providing. So the contrast between the two statements is going to be dollar negative, as the Fed seems to be looking at some maybe further effective easing, while the ECB is getting ready for some gradual tightening. So those diverging policies would favor the euro. The comments from Bullard also gave equity traders a boost of risk appetite, as it implied that the Fed will keep its stimulative measures going for longer. European stocks rose rather sharply, up around 2%. In the DJ Stock 600 and the UK FTSE 100. We also carried over into those stock gains carried over into U.S. trading, as the Dow Jones, Nasdaq, and S&P were all up around 1.3 to 1.4%. We also had gold hit a new high of $1,174 an ounce, and oil tested just below the $80 a barrel level. So, equity markets and commodities were both rallying, and that put pressure on the dollar. Another factor in risk appetite overnight was positive manufacturing and services PMI data from the Eurozone. This was the flash version for November. The manufacturing PMI rose to 51.0 from 50.7, while the services PMI rose to 53.2 from 52.6. The manufacturing PMI was at its highest level now since March of 2008, while the services sector rose to its highest since November 2007. And combining the two indicators in the composite index, we saw that rise to a 2-year high as well. Now, despite the good report, we did have the chief economist of market, which puts out the PMIs, say that the third quarter may have seen a peak to current growth, as we still have high unemployment, and once stimulative measures are withdrawn, and that growth will be subdued heading into next year. So that's something to keep an eye on as we interpret more data coming from those sectors in the Eurozone. Finally, in the U.S., we saw existing home sales in October surge by 10.1%, beating expectations to an annualized rate of 6.10 million. There was a rush of people closing housing deals before the expiration of the first federal tax credit, though that has been extended now by Congress. Inventories decreased by 3.7% to 3.57 million, which represented a 7-month supply at the current sales pace. So that's down from an 8-month supply in September. If we look at our chart to the right, we see that the figure this month is the highest level we've seen since going back to almost the beginning of 2007. And as you can tell, we have the mortgage rate falling down to around 5%. So a low mortgage rate plus the tax credit is helping to revive existing home sales, as we see this trend rising now in existing home sales. So those are our main fundamental factors in today's trading. So let's see how it affected the currency markets. We'll start with the euro-dollar pair, which saw the euro rallying against the greenback. As I mentioned, we had risk appetite, we had diverging views between Fed officials and ECB officials, and that all favored the euro, and as traders sold the greenback. Taking a look at a little bit more price action, we see that we still are stuck within our trading range between 1.48 as support and near 1.50 as our top resistance, and here 1.50 as a sort of secondary line of resistance. So we tested 1.50 rather nicely, and we were unable to penetrate it in today's trade. So we'll see perhaps if traders are unwilling to move above the 1.50 level, as we do have a shortened trading week in the US, as we have Thanksgiving on Thursday, and traders might not want to load up on positions, especially risk appetite positions, heading into a holiday. So we'll see if we continue this ranging pattern, or if we have some kind of move above one of our levels, above our resistance level. In a look at the pound-dollar pair, we see a rather strong rally by the pound following its hitting support late Friday at 1.6450. So we managed to undo most of the gains from Friday's session, and if we take a look at a Fibonacci retracement of our move for all of last week, where we saw the pound slide from 1.69 down to 1.6450, we see that we retraced around 1/3 of that, or 38.2% in the Fibonacci numbers, and so we're sort of consolidating around that level currently. We're also running up against a trend line that, if we connect these highs from early on in November, we see that we fell below. First we moved above that level, then fell below that trend line. Then we used it as a resistance again here, and then now we've bounced down off that level one more time. So similar to the euro, we've had a pretty good rally already, so we'll see if next session holds further greenback weakness, or if today was today's bout of risk appetite sees some correction in tomorrow's trade. Currencies that depend on commodity prices, like the Australian dollar, US dollar, rose sharply in today's trading as well. And if we look at our slide in this pair from last week and plot a Fibonacci retracement, that today's rally, while counting the beginning of late Friday, when the rally first started, after hitting support near 0.9050, we've reached the 61.8% level, 61.8% retracement level of this down move. Last week we also had drawn a couple of trend lines, and if we extend them today, we see that we did break this resistance trend line, and if we extend this old support trend line, we see that today's trading came very close to testing it here. Again, this pair is in a similar situation as the pound dollar, where we had a pretty good rally, and we'll see if it's sustained in tomorrow's trading or not. In a look at the US dollar Canadian dollar, we saw this 3-session rally in favor of the greenback last week, and today we saw the loonie cut into those losses. Today's rally amounted to also around 61.8%, and we bounced up off this downward sloping trend line that we had broken in last week's trading. On the fundamental side, we saw that Canadian retail sales rose 1% in September, which was better than forecast. And if we look at this chart along the right, we see that since January we have been seeing a steady increase in retail sales following a sharp slide to end 2008. Now let's take a look at some upcoming releases. Tonight we have Australia's leading index, and overnight Switzerland will post its UBS consumption indicator along with its employment level. Germany will post its final version of third quarter GDP along with the IFO Business Climate Index. The UK posts mortgage approvals and business investment figures, while the Eurozone will release its industrial new orders. Tomorrow the US posts its second release of third quarter GDP, the S&P House Price Index, a measure of consumer confidence, the Richmond Manufacturing Index, and the FOMC meeting minutes. And that will do it for today's daily video recap. Please go to fxtimes.com for further analysis and videos. Thank you for watching, and happy trading.